as you're thinking about both the sort of China headlines and the vying for TikTok headlines and the interplay here, does this highlight even more the market's perhaps over-reliance on large cap tech? I mean, is this China situation a risk factor that the markets aren't paying enough attention to?
Always good to be with you guys. My shorter answer is absolutely not. I think Dan mentioned it, that this is just jockeying for a better price, or maybe Rick mentioned it. I want to give proper credit, but I think the whole thing is nonsense. Trump's not going to let it stay the way it is. We all know that. It's an election. He's jawboning. He's energizing his base. TikTok is not staying in the ownership of the Chinese. I'll tell you that if I had to bet, I think Microsoft takes it at the end of the day. I don't think there's any debate about that. They want it. They'll take it cash. The price is irrelevant. I've been with you guys several times and your colleagues. July 13th to me was the seminal change in those five stocks, the large cap tech, the big kind of dislocation that we haven't seen since the dot-com bubble. So do I think this is accelerating it? No, I don't. I mean, we're long China and we're long Taiwan through ETFs, and we're sticking with that. And I've pulled back on my large cap techs as well, but I don't think this is the time to sell China. Absolutely not.
Okay, Paul, as you pointed out, and often do, markets can stay irrational longer than investors can stay solvent. So which is the greater threat right now for investors? Is it the tech giants and the potential threats from China, or is it the get our house in order here in the United States? Because we saw what happened over the weekend.
Oh, I think it's certainly the latter. Listen, China is an economic threat. It was last decade, last century. No matter what we do, they're going to become the largest economy on earth. And there's little we can do about that. Sometime in the next 5 to 15 years, that's going to happen. It's not an existential threat. That's just a threat to our global dominance. And as Americans, we don't like that. But in the here and now regarding the markets, the large cap tech, this is not the dot-com bubble. I've argued with this for months. Just because the tech stocks have gone vertical and because Microsoft and Apple own the S&P 500 and everything looks so bubble-esque, it doesn't mean bubbles are generational. These companies have earnings, they're growing their earnings, they've got huge revenues. I just don't think in the next 2 to 3 to 4 or 5 years, they're going to be able to keep these valuations. But the companies, the fundamental base is fine. It's where they are, and valuation is a terrible timing tool. But for my money right now, I would not be running into those five stocks. I think you're seeing today, banks and industrials and materials and transports, they're all breaking out with the Dow and the small caps. And what's happening over the last couple of days, tech is taking a back seat. We should applaud this as healthy, and it's positive rotation into things that should come up a little bit.
But Paul, don't you see kind of the idea that maybe the valuations don't match up with the earnings? I mean, some of these big tech companies, yes. I mean, okay, Microsoft, Apple, Amazon, sure, they have the fundamentals to back it up. But, you look at some of the others out there, I'm thinking something along the lines of newer companies like an Uber, for instance. Those valuations are still way out there. But, we're seeing how fundamentally these companies are being harmed. So is it really just those, small handfuls of the mega stocks that are kind of, I guess, inoculated against the bubble?
Well, you can, if you push me and say we're the bubbles. I mean, look what happened in Kodak, in Nikola, in that Genius stock. I mean, those were, kind of insane, embarrassing, day trading overnight phenomena where everybody got crushed, and they should get crushed. There are consequences when the markets turn on you. Those great, Microsoft, Facebook, Amazon, you guys know the list. Those stocks is where are the probably most crowded trades in the market. Tesla was, but Tesla's not in the same class as Apple and the rest of them. So those five stocks don't have to collapse. Everyone's thinking they're eventually going to collapse. They don't have to. They could go sideways and then gently trend lower as earnings catch up. Walter Deemer posted a great chart about McDonald's as in the Nifty 50 in the 70s today. And as earnings went up the side of the page at a 45-degree angle after the Nifty 50 was burst in January of 73, what happened? The stock price went sideways and down. So the market will eventually catch up to the price action of these great five companies, but I don't think they're going to reward investors over the next 12 months vis-a-vis the other stock, the other 4,000 stocks in that trade.
There are other stocks. Paul Schatz, thank you so much. It's always good to see
Yes,
you.
there are.
Heritage Capital President. Appreciate it.